Welcome, everyone, to The Real Investment, capitalizing on the future of film. Thanks to everybody for joining. We've got some great panelists here. We've got a full room of investors, and we're excited. Film is very exciting. It's evolving. It's growing. Today, we're going to deep dive on a number of topics for investors getting oriented to this awesome asset class. My name's Eric Cantor. I'm your moderator. I'm the CEO here at Vincent. We help individual investors get smarter about private markets, and we're going to try to do that today. You can find us and a recording of this event at www.withvincent.com, as in invest with Vincent. Let me give you a quick overview of what we're going to do for the next 45 minutes. There's going to be three sections of this discussion. First, we'll introduce our awesome set of film finance leaders who are going to be teaching us and reviewing some interesting learnings and trends with us today. I'm going to review a bit of high-level data on the industry just to orient that conversation. Second, they're going to talk us through some of the opportunities, some of the risks, some things to watch out for if you're getting into film investing. And third and last, we're going to take questions from the audience here. So please, whenever you're ready, now or later, drop a question in the Q&A and we'll prioritize and get to the ones we can get to. If we cannot get to them, as happened last time, we will follow up with an email with the best answers we can as soon as we can. Before we dig in, just a quick reminder that this discussion is not going to give you any financial advice. We are all operating on our own allocations, our own investment decisions, our own advisors. Nothing you're going to hear constitutes financial advice. You should make your own decision. Now that we've got that under our belt, let's introduce you to our three panelists today. For each of you, why don't you give us a couple minutes just telling us about yourself, your firm, and your investment offerings. Let's start with Marc from Republic.
Thanks so much, Eric, and to the fellow panelists and to the great Vincent community joining here. I'm Marc. My background is in traditional film financing, mostly equity financing, working with high net worth investors around the world into $5 to $20 million films, which is considered sort of the independent mid-range category. And on the creative production side as well, developing and selling TV shows, documentaries to the major studios and streamers. And really what happened during COVID is I started to dive deep into the world of decentralized finance, blockchain, crypto, and try to figure out how we can bridge the two worlds of film and obviously this movement that we see is in full throttle, and essentially to create additional paths for film investing other than just the traditional angels and institutions or studio deals. And of course, we saw what happened with sort of Web3 and that boom with art assets, NFTs, art, music. Film is a very particular industry, and you get paid in dividends, which are essentially securities. And so it was essential to find a partner that had all the licenses, regulatory framework that could issue securities to accredited and unaccredited individuals, which is why I found Republic. And Republic, has been around essentially since the 2014 Obama Jobs Act, which allowed for certain securities exemptions to issue securities to unaccredited U.S. investors, which is really an incredible moat that Republic has, and is probably the most retail-facing of these platforms, with a community of 3 million users and a track record of having deployed $2.6 billion across tech, startup, real estate, gaming. And obviously with this kind of traction, I said we got to apply this to the film and entertainment world. So allowing, the power of now allowing not just the high net worth or the angels and the studios to basically decide what gets invested and greenlit in, but also allowing filmmakers and projects and producers, directors, production companies, studios to access investment from their fans and audiences, which not only allows a creator to hold on to their financing journey with more leverage, but also to independently control their IP, to have more leverage in the deal making, and even when it comes to distribution, I would say drive the bottom line of that film, because there's an entire community sitting behind the film, telling all their friends and family to go see it. So we have been solidly building new revenue share securities instruments. A lot of the companies on Republic are equity instruments into startups, with a valuation for an exit, whereas in film, you share in the revenue in perpetuity of the net profits and of certain revenue corridors as a film goes to market. And we just launched a development slate for Pressman Film. Pressman Film produced American Psycho, Wall Street, Bad Lieutenant, The Crow, Thank You for Smoking, Conan the Barbarian. So just all these epic independent films. And the narrative there is, let's make more movies like that again and not wait for just the studio development deals to greenlight those. And so they put up their campaign on republic.com/Pressman, and they're currently close to $2 million, which is development financing is significantly lower because you're just paying for you're financing scripts and IP and things like that. So there's clear traction in this space, and we have a couple of other upcoming projects in the development space, the production space, and the distribution space, which I'm sure we'll touch on later. But it's an exciting time, and that's sort of what we're bringing to market in what we call tokenized film financing space.
Awesome. Jon from FilmHedge, you want to introduce yourself?
Hi, John here from FilmHedge. My background has primarily been in tech, building software companies around the world, having exited from two over the past 10 years. And what's interesting is I took a lot of what I learned in the tech world and applied it to solving the problem of film finance. So after an exit a couple of years ago, I started to put money into film and TV productions just as an individual investor. And really the reason why was because film has always been a place that sort of fascinated me, and but it intimidated me in that I went to film school. They teach you everything in film school except for how to finance a film. And so when I got out of school, and over the years, it always nagged in the back of my mind. It's like, I've always wanted to make a movie, but I don't know where the money comes from. I don't know how the money behind the scenes works. How do I figure it out? I happen to have a big windfall of cash from an exit. And so I started to finance movies and TV shows as an individual. And in doing so, I learned the sort of inefficiencies in the way financing, specifically debt financing, is applied to film and TV. And so after I did my first 4 movies, I had great returns. It was consistent. It was reliable. And one thing you learn in the tech space is if there's inefficiencies in the market and there's a reliable, repeatable solution, that leads to scale, that leads to being able to build products that address the problem at scale, which is what venture capitalists look for. And so FilmHedge is a venture-backed technology company that uses data, analytics, and technology to improve the way films are underwritten, analyzed, and that leads to better financial decisions and outcomes for both large investors like the backers that we have, who've backed us with over $300 million, as well as smaller individual investors who maybe only have a few thousand or tens of thousands of dollars, and they want to participate in the space.
Awesome. Last but certainly not least, Jay, tell us about Slated.
Thanks very much, Eric. Slated is a film platform specifically for independent films. We have 80,000 members in the community. We've got 20,000 film producers. We have 2,300 investor companies. We are working on our 70th film as a team. We're done with 65, and we have an analytics platform that specifically rewards the creative and financial building that takes place before a shoot. So our script analysis is extremely successful in predicting whether a movie will be good. Our financial analysis dives into whether it is the right type of film with the right type of distribution, the right type of government incentives in place. And we've used those tools effectively at this point. And our last 16 of our last 17 films are fresh by Rotten Tomatoes. During the COVID work stoppage, we built out some of our sales and distribution tools internally. And then during the strikes, we actually realized that it made more sense for us to just become a worldwide distributor. So we've now released 6 films, and our 7th film, The Big Dog, is being released on transactional platforms tomorrow.
Congrats on that. Great. So you can see we have some really experienced investors, financiers, entrepreneurs here that are going to talk to us. Before we do that, let's just review a little bit of data about the industry just to situate ourselves. So first off, film is a big market. It's growing. It's also quite visible. I mean, it's not some arcane B2B software you've never heard of, right? It's films that you see them on TV, you go to the theater. Quite similar to the sports investing discussion we had a couple months ago, where we talked about investing in some of the soccer teams. You know, films are also things that you would like to get access to because you actually see them in your day to day. And that the story Jon told about, being an entrepreneur, having some investable capital, going on that journey is definitely one we want to all emulate, or at least many of us. That's why we're here. I know I am. In terms of an asset class, film really boasts some of the highest risk-adjusted returns, right? It's similar to venture. Marc mentioned venture. Most of us here have experience in venture one way or other. It's really a hits-driven business. And you can see, from this graph that as asset classes compare, film is going to be, very high risk and very high returns. In fact, here they've got it second only to oil and gas, which of course are real hit or miss type businesses. Now, if you're looking at film, you want to think about independent projects. Again, I'm going to use my venture hat since I'm still learning about film, but let's call this the seed round of getting into film, or investing in micro budget opportunities where the amount of capital isn't overwhelming. It's not a $300 million studio picture. Just this year, we have 3 examples here of films that, one of them 4X'd, one of them 30, if you do my math, 38X'd, and so on. And so indie film is one of the best places to be positioned in this ecosystem. We can talk about other places you might be able to find your capital. Like venture, film also has a life cycle, right? So different investors, different managers are going to be positioned at different stages of the production process, different vintages and maturities of each product. We're going to talk about that a lot today too, like where you come in, what kind of capital you're using. Is it debt? Is it equity? Are you taking that initial concept risk, or are you taking something that's already been made and trying to bring it to festivals? Last, there are a few ways that as an individual we can get access to films, right? You can go directly. Maybe you have a cousin who's making a film and you want to get involved. There's some crowd investing sites. I'm sure Marc's going to cover that. And there are other ways to get your capital in. Debt investing is also quite interesting. We're going to talk about that today. But there's a number of ways to get involved, and we'd like to get an understanding of what those look like and how, as an individual, we can access that. So with that, why don't we start our discussion? I'm going to ask a series of questions, give each panelist a couple minutes to answer them. Let's start with Marc on the first one, and let's talk about timing in the market. Here we are. Why is now a good time to get involved in film financing? And what's exciting about the asset class right now today?
Thanks, Eric. Well, it's inherently always an exciting asset class. Not, as you mentioned, not just for the venture-sized returns that you can receive, but also for the perks that you have attending festivals and being part of bringing a creative project to life along the journey. And there's different parts you can play along that journey, as you specified, from more seed capital style investing across a slate of projects in the development stage to debt financing at the end of the journey, really into the distribution expenses of a film, or even against government tax credits and things like that. Now, as you saw, it's a really interesting time right now, sort of with a bit of the Marvel fatigue and the streamer fatigue that we are hearing all around us. Yet the box office per film is increasing, actually, and projected to increase 7% already, even next year. And as you saw from those sort of lower budget to mid-range films, horror is celebrity agnostic, with a dedicated fan base, with low budget, low marketing needs, and really high traction, basically, in the box office. And between sort of the resurgence of going to the theaters, of these dedicated experiences to these genre films. And also just the innovation of technology that I'm sure we'll address later that we're seeing happening in the marketplace. You're going to get more efficiencies as well in the film production journey. And that really is an exciting time to sort of play and invest in projects that are probably going to follow the lead of films like Terrifier 3, smaller franchise-driven IP, Anora, which is still about to have its its awards run, and so it's probably going to increase that gross revenue number, and also just what Republic is doing as well, kind of just innovating this new pathway to invest and to diversify your portfolio into these uncorrelated asset classes. I think that's also going to make a lot of buzz, a lot of headway. And it's also going to engage audiences in a new form of sort of, excitement and fan engagement in the film category that is also going to just spark innovation and make it a really exciting time to innovate Hollywood. I mean, if you look at the news cycle for Hollywood, it's been a tough year. There were the strikes the year before that, but it feels like, out of the depths kind of come light. And it's a really exciting time to end the year and start 2025.
Jay, what's your take on today's market?
Yeah, I think people love the movies. I love the movies. I got into the business because I was a fan of watching movies, both in cinemas and at home. And I think that it's always a good time to participate in the space. But where we differentiate ourselves is that we are really strongly against bad movies. We want our films to be particularly good. What we've discovered over time is that if you're making movies that investors are proud of from a creative standpoint, it actually makes the process of recoupment, which is a 3-year process typically, it makes that process a lot more palatable for the investors. If we're always working on movies that ultimately are enjoyable, and whether they're uplifting or scary or they touch some part of the audience, that works for us. That really is our core strength. I think that the perks in the space are, look, it's a glamorous business. Our investors are welcome to go to the set, and also there are myriad opportunities for them to then later on, participate in like a red carpet environment at film festivals. We've had films premiere at every major festival in the world except for Telluride and Venice. So we have 2 left to check off. But we had both the Friday night movie and the Saturday night film at Cannes this year, and it's a great environment. And I think it's a perpetually exciting and creative and enjoyable space that can also be challenging. So we kind of feel like it's important to know what you want from the process.
Awesome. Definite bucket list material right there. Jon, what's your take on where we're at in today's market?
I think the market's really attractive right now because it's so volatile. What's interesting is you hear all the headlines about how Hollywood is in a slump, and production is very much in a slump right now. It's slowed down a lot. But on our side of the business as financiers, particularly the type of financing we provide, the market is really busy. And that's because there are still films being made somewhere in the world, not necessarily in Hollywood, not necessarily in the United States. We fund globally, we always have. And I would say right now, the productions we're working on are probably 20% international and 80% domestic, in only 20% LA. So the slowdown that you hear about that's hitting everybody in LA isn't necessarily happening everywhere else. And I think that's part of the story that we forget, is that what used to be a concentrated market where everything happened is now dispersed throughout the country and world. And so there's still a lot of money to be made if you're an investor looking to get into this asset class, particularly on the debt side, where we are following effectively purchase orders that have already been placed for the material that's being produced. And so we don't have to worry about if there's a market for it. We're sort of targeting a captured market already, and then just cash flowing it until it's released to the public, and we make money either way. So for FilmHedge and debt financiers like us, I would say the market's actually pretty healthy right now.
Does that imply, as an investor with you, I'm sort of less upside, less downside relative to writing my cousin a check for his new screenplay?
Yeah. So one of the things about going direct when you're financing a movie directly is you're taking on all the risks of being a direct investor. And, they always say know your risk if you're an investor. But in the film space, what a lot of people forget is that there's so much more you need to know than whether or not, you cut the check, you sign the documents with somebody, and they said they're going to make a movie. Have you solved for if the fact, if they don't happen to make the movie for whatever reason, it may not be ill intent, they may just not complete the movie. What happens then? How are you protected? If they do make the movie, what does the camera and the waterfall look like to ensure you get your money back? You always hear about, quote unquote, Hollywood accounting, where people put money into a movie that seems to be profitable, but they never get any money back. Well, it's probably because they're at the bottom of the camera. And we can get into stuff like that later. But there's ways that you can protect yourself. FilmHedge exists because I recognize that the big problem to solve, I was solving my own problem as an investor, is how do we make it safer for folks with capital to put it to work in the film and TV space. And you, Eric, you captured one of the things we say every day is like we limit your downside risk, but that inherently means that your upside risk is also lower. And I would much rather be in that safe zone of like, you're not going to lose a lot, you're going to make a certain amount every time, but it's capped, than to, swing for the fences every single time and hope to have like a $1 billion movie that's going to pay everybody back 20x.
Awesome. Appreciate that deep dive. So moving on, let's spin the camera around, so to speak, and think about from the investor perspective. We talked about the market, what's happening in the overall market. Let's talk now about the investors that are on your platform and your network, yourselves. What are the opportunities and trends that investors are most excited about, and how are they reacting to the current kind of market conditions? Jay, you want to kick this one off?
Sure. I would say that our investor profile is very diverse because we have 2,300 companies. So that's a fairly large, like, amphitheater level of companies. And so I think what people are really interested in and focused on right now is the opportunities in two different categories. So like Jon was saying, basically you have an incentive-rich environment, specifically in certain territories. It's very competitive because if a government provides that incentive to production, then more productions take place in that territory. So right now, the UK went to solve a very specific problem, which was that London had a kind of knock-on effect slump in production that followed from the strikes. The production rate in London was very, very low. It was kind of, multi-year low. And so the government took action and they torqued up the incentive. And now everyone wants to shoot in the UK because the return for just going there is baked in. And so that's where, as a debt investor, you're able to finance that in advance because you know that the government effectively you have very little credit risk there. The government is going to be good for that incentive. So we have those folks that are interested in building out a debt profile. It's a lot bigger number on kind of on a per show average. If it's 40% of the budget and the average budget is somewhere around $3 million, then you're looking at, that's effectively like $1.2 million that you would need to lend in order to meet that incentive. So it's harder to become a debt investor in the film space. Equity investors are really focused on, kind of lower budget films. We know that horror films historically are the best genre to invest in. specifically for equity investors. When we use our financial analysis tools, literally, if you input that the genre is horror, it causes all the levels to rise. And so I think that, you know, what's really interesting in terms of how trends are moving right now is that you had an inflationary spike, so production costs are up. You also had a bit of a slump for you know, transactional, and then the rise of AVOD in terms of platforms. So the monetization cycle has been kind of going like this. What you have is films are harder to produce, but they're not returning as much as often. But you have all of this change that just took place in a really short amount of time, and it's finally kind of leveled out. And so finally we have like a stable home video environment, which is that all the AVOD world is rising. I think we're done in terms of like new studio platforms in the SVOD space, and transactionals coming back. It's you know, a little lumpy, and then the box office is kind of that last tent pole where basically box office really took a hit during the COVID era, and now you know, we're starting to get closer and closer to those 2019 levels. You know, there were record turnout. There was record turnout in the Thanksgiving period for a couple of different movies that just came out. So, you know, where we see the investors move is really wherever those trends sort of indicate it's a little bit safer, it's a little friendlier. And then, you know, holistically, our whole goal is like, let's make good movies so that at least we can enjoy the ride.
We just double click on one point you made there, just on a quick hit. You said horror was the best performing genre. And I don't know if that's in
Yes.
terms of dollars in to dollars out or some other metric. Can you just tell us and this ties in with a couple of questions that are coming in from viewers. Can you tell us the top 3 categories? And then also mention, if it didn't make the top 3, where documentary fits in that ranking that you just gave?
So, I mean, like the data breaks out in different ways because you have to look at like North America versus international. But that's the funny thing about the horror business, is that is the number one genre. Drama is actually considered to be the toughest genre right now. Drama, just a standard sort of, you know, people going about their business drama. That was such a bad category that Screen International actually published after one of the markets, I think it was Berlin, that people were going around saying no drama, which is frankly insane, but it was just that hard out there. There were too many of them. It's the most produced genre, and they weren't selling well internationally. Documentaries are really tough. There is a lot of reality content that overlaps in the documentary space. Documentaries, though, just had a heyday as recently as I think it was 2019 when Three Perfect Strangers, RBG, and then there was another doc that really broke out. It did nearly $20 million theatrically. You know, documentaries are tough, but they're easier from a technological standpoint. So you don't have to worry about you know, paying SAG. You don't have to worry about paying the DGA as much. And so ultimately, you know, documentaries are a tough category, but they can break out. We've seen it in the past. And I think that that's a space where there's a bit of a social importance to it. It's relevant always. B, you know, I think that people really have a love for documentaries, and they feel like a passion for the category. It's very different from a dramatic film. And then, you know, ultimately, I would say that like the number 2 genre is action. You know, like action movies are the thing that the market can't get enough of. It is harder to make them because you then have, you know, stunt days and stunt, you know, expenses. And so that's a really interesting space right now. And I'll leave it at that for now.
Yeah, if I can add to what Jay said briefly, one strategy a lot of filmmakers employ is to sort of, for the reason that drama isn't so easy to sell right now, is to blend the genres. So you do like an action thriller or a horror action movie or a horror thriller. there's a lot of genre crossing right now because it makes the projects easier to sell from a pure, there might be creative reasons for that, but there's also, sort of, the finance strategy of it all that might be driving some of that.
And I'd love to also.
Yeah,
Go ahead, Eric.
No, I was I just keep my scorecard here. So it's horror, action, and then
it's thriller.
okay, great.
So
Sorry,
thriller
go ahead,
as
Marc.
a separate category from horror, meaning psychological thriller. And I think what Jon said is particularly relevant. I think that, comedy works if there are action elements. So if you make a $30 million action comedy that's hilarious, that can be the best category of all. It's really tough to execute those it's really hard to make a very funny movie and then also do a lot of stunt work. And the people that are, specialists in those fields, they don't necessarily always cross over perfectly. And so those are hard to execute. I think that it can be the most rewarding, but they're few and far between, the successes.
It is
Marc,
interesting.
you want to chime in?
Just to add on the documentary front, as a having worked on documentaries for years as well, as Jay was saying, there was a heyday in 2019. There was a heyday actually during COVID where Tiger King was like 11 episodes, and those were easy to make because you couldn't go out and film on sound stages, and so it was archival based post-production work as opposed to live filming work. And those had a huge premium because they are so cheap to make, and there's always a demand for them. And still, the top performing categories on streamers are true crime, and the latest, who did it, murder type of or true crime story. And those are documentaries. And I aware that this audience might not know all the entire film kind of value chain and sales process, but if you're investing into a relatively cheap to make documentary and there's a social cause behind it, and if you imagine that documentary goes to a festival and gets a lot of buzz, there could very well still be a bidding war for that documentary, or more likely, you're going to be feeding the demand that these streamers still do have for true crime. So those are going to be bought by a streamer. It might not have huge box office runaway upside, but it'll be bought at a premium, and you will be in the black and with a healthy return. So it is all cyclical, and I totally agree that those are the top performing categories in terms of really interesting upside. But there's somehow still true crime still has a steady demand always.
Awesome. Let's turn up the heat a little bit because we're in the weeds now, which is where we want to be. We got about 20 more minutes. We got some questions floating in. So let's do the elevator question. I'm stuck with you in an elevator for 60 seconds. Pitch me. Why is your product the best product to invest in film right now today? Marc, you want to kick this one off?
Yeah, well, we are a platform that curates really premium and extremely diligenced content and premium film investing opportunities for retail audiences. And as you saw earlier on that chart, what we do is we're really curating offerings along the value chain. So development capital you can think of as seed capital into film ideas such as scripts, IP optioning, sort of to spark the fire of a project. Production financing is when you're sitting as an equity slug in the production budget of a, let's say, $5 to $20 million film. And you're sharing in that back end in perpetuity. With development financing, you're getting actually recouped from revenue quarters out of the budget. So no matter as long as soon as it gets greenlit, you're getting paid back your premium. You're getting shares of the producer fee, and you're still getting some pieces of those back end points. Production financing, you're pro rata basically as an owner in the revenues, the back end of that film in perpetuity. And then there's distribution financing or debt financing, which I'm sure Jon will go into, which is, as Jon mentioned, kind of capped upside, but more steady and assured returns. And what we do is we finally enable access to that. And we're regulated by the SEC Republic. We're sort of, it's our priority to make sure that we're bringing quality deals and vetting them to the public, and And we've just seen a lot of audience excitement on that front so far. Skybound, the studio behind The Walking Dead and Invincible TV shows, they raised 18 million on our platform last year, allowing fans to invest into the studio that brought you this IP, and the imperative to be an owner in the content that you ultimately consume. There's no better fan engagement than that. Republic I know I've gone over 60 seconds, but it's just, we have a real specialty to provide a new access to this exciting asset class. And I think we're going all in.
Thanks. Just to follow up on that with one viewer question, is crowd investing, is that synonymous with what Republic is doing, or do you do other types of investing? Someone asked about how crowd investing works, so maybe just
and I will add one element to that. So Republic, is a broker dealer platform. It's a merchant bank. There's a hedge fund division as well, a venture arm, and a blockchain crypto services kind of consulting arm as well. The larger idea, I mentioned the word tokenization early on, is so Republic has all the licenses globally to allow for all types of investors to invest in these asset classes. In the US, particularly the Reg CF funding portal, which allows for unaccredited investors to invest into ventures or projects and receive back end as dividends or securities. That's obviously different from crowdfunding sites, which are simply donations that don't have those licenses. So we are unique in that aspect. We have the most number of licenses and the largest retail audience of a very small handful of these types of platforms. The other interesting element is the idea of tokenization, that you can create liquidity and sell your share in a project on a secondary market. And that is kind of, a big driving force happening in the traditional finance world as well, just creating liquidity across all types of asset classes. And the idea is that you'll be able to sell your share in the next cult film. If you invest in the next American Psycho, that share in the equity would have gone up, and you can trade that on, or if you're investing in a studio, trade that on, and cash out in that sense. So we provide that capability too.
Exciting. Let's get back on track with the pitches. So Jon, you're up next. Give us your elevator pitch.
Yeah. So if you think about the difference between being a retail investor or an individual accredited investor, angel investor, what have you, and institutional investors, is the level of diligence and the level of risk that's been mitigated in every deal that's done. We bring institutional diligence to film and TV finance, and then we give access to our deals to individual angel accredited and retail investors, as well as other institutional investors. So I always like to say we are a platform that makes film and TV financing safer for folks with money who want to participate in the space. We can get into how and the why in the later discussion. But the other thing to remember is it's more than about just having access to the money. You need access to the deal flow. And so FilmHedge originates around $200 billion in potential lending opportunities annually. So applicants, not deals done. And that is from some of the best creators in Hollywood, some studio films, mostly independent films. And that's access that money, quote unquote, can't buy. And so by being a participant on our platform, in our network, you get access to deal flow, and then you also get the risk mitigated significantly.
Right. Jay, give us the Slated pitch.
We make good movies. I think that really is the pitch. But the reason that it's interesting is that the analytics, when launched at the end of 2015, were lambasted by our investors. Our investors hated the financial analytics. They hated the script analysis. We got invected from the other end of the phone on a nearly a constant basis. When we had a #1 movie open on 4/20/2018, everything flipped. The irony is that the financial analysis was an AI machine learning product. So, we just were a little bit ahead of the big data kind of cycle. And by the end of 2018, because we had a success, the whole story flipped on its head, and people started saying, keep doing what you're doing. And now, obviously, AI is a buzzword. It's a massive growing behemoth. And of course, people would think about analytics when it comes to investing. So there's a bit of an irony there. But the fact is that we were field testing the whole time to make sure that the movies that we were making were good. And so we ended up with a #1 film, which was Super Troopers 2, which is a movie that I very much love. But we've also started the careers of young filmmakers. We have 80,000 people on the platform. We back first-time directors, but we have, basically a rules-based system. So they have to have really great scripts. We have a way to measure that. And then, what ends up happening is that at the other end of the pipeline, you end up with movies that actually work creatively. And so that's what's unique about us, is that the data piece of it is something that we started early and people were very skeptical about. But now, years on, all of our movies are being received well, and it actually is a very functional sort of assembly line, but it's coming from 80,000 people. I mean, it's a unique environment. And so that's what's kind of special about Slated, the platform.
Great. So I've heard all your pitches now, and I'm excited. I want to start investing. So, and that probably goes for many of the people on this call. So think about a potential investor. How should she conduct diligence, do research, look deeply into these products, and figure out exactly how I want to play? I'm going to lump another question that came in with this question just for time efficiency, since we're running short here. When I do that diligence, I want you to tell me how to do it, but also, should I be thinking about building a portfolio of films on my own? Should I think about finding a manager, such as one of you, to put me into a series of films? It's like, in the public markets, I buy NVIDIA, but I also buy some index funds. Is it a hybrid approach like that, or is it something else? So how do I diligence, and how should I be thinking about this overall kind of portfolio that I'm allocating to here? Why don't we have Jon start off on this one?
Yeah, so that's a great question. So to answer the first part of it, how do you diligence a film? I would say do your best to find a quality entertainment attorney. I found, before I started FilmHedge, I found my first big movie. It was a $10 million movie, and I had maybe $500,000 to invest. Not every day you get to put $500,000 into a $10 million movie that's effectively already been made, but my entertainment attorney found that deal for me because he was representing the project. So in the way you can find quality entertainment attorneys, look up your favorite movie, see who the counsel was on IMDb, and reach out to them, and they'll either take you as a client or they won't. If they don't take you, just find the next one. Someone will take you on if you're serious about doing deals. But to answer the second part of the question is, what do you do next? Well, if you're interested in FilmHedge, we have really 3 tiers of investors who work with us. So one is the institutional folks. So these are hedge funds, family offices, billionaires, and large groups that give us hundreds of millions of dollars at a time. Probably not most of the people in this audience, but if you are, definitely give us a call. The other 2, though, are going to be people who are sort of, as we have described in this conversation thus far, retail investors, or what I would call angel investors or accredited investors. And there's a slight difference between the 2, which Marc could probably explain better than I can. But we mostly deal with like the angels of the world, people who have 100 to couple $100,000, maybe a couple $1 million to deploy, and they want to sit alongside FilmHedge because they know that we're writing money drawing from these large institutional credit lines. So they get to bring, much like I did, 6 years ago, they get to bring $500,000 to a $10 million conversation and not get laughed out of the room. That's really the sweet spot for what we call co-lenders on the FilmHedge platform. And then we are working on ways of opening this same opportunity to retail investors, and we're excited to talk about that early next year.
Great. So talking about retail investors, why don't we jump to Marc, who's facilitated quite a bit of that. And when you answer this question, I guess I'd like you to work on 3 levels. And number 1 is, how does Republic vet the projects that are coming on? Somebody asked about that. Secondarily, how do I, coming in looking what's past your filter, how do I research, diligence, and filter it? And then once something passes the filter, what should I be doing, or how should I be thinking about my allocation to the asset class? Should I be building portfolio 5 or 10? Should I just say, yeah, anything that Marc approves, I'm backing, or how do you think, how should I be thinking about building my portfolio on top of your diligence?
Yeah. As you can see behind me, sort of Republic is mostly comprised of lawyers and these engineers, and I'm the funky film guy over here. I'm very, very focused, having just launched this sort of new film vertical on premium and quality deals from my experience in producing films such as Hotel Mumbai a couple years ago, Dollyland with Pressman Film and Ben Kingsley last year, and some of these genre films that have been at festivals and returned, and the first few on the platform, really we want to be as premium and vetted as possible, and obviously create a good asset class for investors. So I do my diligence on the producerial front, and then the diligence team actually parallel tracks while I do marketing as soon as we sign somebody, to go through all the obviously systems and background checks and KYC and all of those types of diligence research that we would do on any issuer. And then most of these are names and projects that you would have heard of in the mainstream anyways. I know that obviously Jay's platform also has ways of, checking the quality of things. Jon is an expert in the debt financing space. And what Jon was saying about, doing your own legal, but really a big pro of the platform as well is we're talking to film festivals and different, even investor groups, philanthropic groups, or whatever it is, to even just deploy Republic as a standardized form, because then you don't have to spend all of that money on your own legal. It's one link with one securities instrument that goes out to everybody. That can actually save festivals and production companies a lot of like overhead and back end work too. And then lastly, so that's sort of diligence process, UX advantages of Republic's platform. The last thing is, as I mentioned, we are issuing offerings in all these categories. I encourage diversification. Developments or slate developments, opportunities where you're not just investing in the development of one film, but a slate of 5 across Pressman or across renowned horror directors and action directors as well that we have coming up. And similarly, you can balance that with some production and debt financing or distribution financing opportunities that are a little bit more standardized on the other end. So I encourage to have fun, but to mitigate with safer opportunities as well.
Just to add to that, a couple people were asking about the tokenization. So do you want to say one more word about how does that work, and are any of the films being tokenized today?
All the film projects raises on Republic are tokenized. We obviously put it through the Reg CF platform so that accredited and unaccredited retail can invest. And then think about your share in that film as basically, backed up on a blockchain. We are blockchain agnostic, so we work with Avalanche, Solana, Ethereum, Polygon, a whole range of them. Essentially what the blockchain enables is for these financial distributions to be paid out faster, efficiently, more cost effectively, for transparency in the accounting process, and also that ability to trade your share on a secondary platform. We at Republic have bought over a ATS called INX, where they'll be available for trading as well as on our dashboard. And you can see sort of one first tokenized equity project, Republic Note, where we're tokenizing secondary liquidity for all the carry in all of the ventures that Republic has invested in. So we're definitely pioneering that space.
Right. Jay, last word on diligencing and portfolio building?
Yeah, so we're a B2B model. So we're most interested in working with people that already have either a company that's based in the film world, or an LLC that's for their own investments, or they're a manager of funds. And so we have an open platform, so it's free to sign up. We approve about 1 out of 10 investor applications. And the reason is that film production is expensive. When you the risks in the space are incredibly high. It is a space that is fraught with peril. And so what we try to do is we try to take care of the investors in a number of different ways. But the key emphasis and the core emphasis is to work with accredited investors only, to provide them with analytics that they can't, get anywhere else in a kind of a comprehensive way, and then ultimately to tell them what the risks really are. Equity investors in film are looking at a space that where only 1 in 5 films typically recoup, and it takes 3 years to recoup. The film investment model, if it has the closest analog, would probably be real estate. There's a debt stack, there's maybe a gap or mezzanine piece of debt in the middle, and then there are equity investors on the bottom. What is incredibly risky and quite frankly foolish is to invest in a friend of a friend's movie that doesn't have distribution, that doesn't have well-known stars. It can. I think that one of the biggest mistakes that film investors make is that they believe producers who present to them, decks where only the upside is featured. And I think that it is a much riskier space than most. And strangely, because everyone can watch movies at home, a lot of people think that they can just make a film and then release it and make money from it. And that's kind of like if you were, a high school basketball player, just assuming that you could play in the NBA. And it's a space where there are a lot of ways to lose. So making really good films is just one piece of a broader strategy. It is a hits-driven business, and I think that should be kind of the thing that's said over and over again. You need to make sure that you're in movies that are particularly good, that have a chance to break out, and then that will cover some of the others that maybe turn out to be ordinary. And ordinary films can get killed in a tough market.
Makes total sense. We've really gotten deep here, and this has been a great discussion. We have time for one more question. I'm going to wrap a couple of the audience questions came into it for each of you. So let's talk about what's going to happen moving forward, right? Some different scenarios, a lot of moving parts, right? We have media's evolution, which continues, the growing role of AI. A couple of people ask questions about overseas production. We've got a new rate cycle. We've got a new president coming in. So give us your crystal ball in the next 3 to 5 years, starting with, Q1 2025. What do you expect to see that'll be exciting, interesting, or different that people should keep their eyes open to? Why don't we start with Jon on this one?
Well, I think it's interesting. I think one thing that's good about the film and TV industry just generally is, despite what a lot of people think about how sort of Hollywood leans one way or the other politically, the industry as a whole has had bipartisan support. And I'll give you an example. There's been a part of the tax code that allows for very healthy deductions related to film and TV investment for the past, I think, since 2015 or maybe since 2011, which is called Section 181. That means it's crossed multiple administrations and it's remained in the tax code. I'm hopeful that continues to be the case. It's a very healthy and attractive way that equity investors are incentivized to put money into films, and it allows them to sort of get two benefits. One would be the equity participation in the film, but the other benefit is tax deductions or write-offs for everybody else. And so that makes it a really attractive opportunity for them. It's more than just the money they will potentially make on a film. There's a solid, almost guaranteed return from just spending money making the film. And so that is one thing that I'm hopeful continues. It's very similar to the state tax credits that exist around the country and the country tax credits that exist around the world, but just at the sort of federal level here in the United States only, that program exists. Other things that I think will continue, I think the rise of private credit and debt financing and media is one to be studied. We put out a research paper about a year ago that Variety circulated that talked all about the rise of private credit in media. And I think the reason for that is, to use the same analogy Jay did, a private credit in financing film and TV is a lot like financing real estate deals. Same risk profile, very similar return profile. You just get the added benefits of the cool factor of being a part of feature films and going to red carpet premieres and being able to say, yeah, I backed this movie by my favorite director or my favorite actor or actress. And those are the things that we're excited to make available to the investors who are partnering with FilmHedge.
Awesome. Jay, what's in your crystal ball?
Well, I'm really excited that we're getting back to normal. I think that we've had an unprecedented amount of dislocation. To have every movie theater in the world threatened with closure in 2020 was something that was really, really challenging for everybody in the business. And the follow through of those revenues that then didn't flow through the system was a painful time. And then we had all of the inflation and the COVID testing that you had to do when we got back to work and movies started being produced again. Then we had the labor stoppages. So I'm just happy that things have kind of finally settled down and that we're making roughly a movie a month. We've been making roughly a movie a month in a non-strike environment since April 2021. What I'm excited about is that I know who the big SVOD players are. I know who the big AVOD players are. I see a kind of stabilization and just to add to what Jon was saying, the incentive climate has been more favorable, and that has actually been moving forward. And so that debt piece that I can finance my movie if I'm a producer on day one because there's a 30% of my budget piece of the capital stack that I can get a loan for. That's a very exciting thing when it's a competitive environment. I think the governments around the world have understood that they don't want to have that production go away. And even California, after years of kind of struggling with, some exodus, has amped up the incentive. So, I think that it's a very exciting year, 2025, because we have a lot of opportunity. We have great movie stars that are working in the independent film space. And I just don't see as many of the dark clouds on the horizon as we've had in the last 4 years.
Makes a ton of sense. And definitely every time you turn a corner in the west side of Manhattan, you see one of those trailers and wonder what they're shooting. So good things ahead. Last comment of the day, we'll go to Marc. Marc, what are you looking forward to in next year and beyond?
Yeah, I think I'll end it just on the thought that we're all here in the spirit of making great movies, better movies. We're all innovating with tech. I think what Slated does is it creates standardized efficiencies in filmmaking for filmmakers. What Jon does is innovate a really exciting kind of investment opportunity. And what we do is expand access to invest outside of the major kind of even sometimes predatory studio and streamer controls, or just, the idea that why should the person on the yacht only have the chance to green light what they want to see in this world? I mean, films are amazing. We think about them all day in the shower with our friends. They inspire us. I mean, like this, by sort of redistributing green light control and opportunity to the audiences themselves, I think we can reinvigorate a new era of really exciting independent film. And I think everybody's noticed that that's been missing over the last few years. So I think just to reiterate, what everyone said, diligence is important, track record is important, but there's really kind of exciting opportunity now for new blood. And I do think that actually technology, even AI, will actually democratize more access and more origination of ideas and filmmakers and shake things up in a good way.
Great way to close a great conversation. Thank you to everybody. This has been an inspiring conversation. Film is inspiring and got a lot to look forward to in this ecosystem. Thanks to everybody who stuck with us through this through the time, and happy holidays to all. We'll see you at our next event.